Okay, so back to this costing method. Okay, there are 4 costing methods that are acceptable under GAAP. Okay, we're going to talk about these in detail. FIFO stands for first in, first out. LIFO stands for last in, first out. Weighted average and specific identification. Okay, so these 4, it's kind of at the discretion of the company, and kind of for this one, it's also has to be like it's like this one is for like special situation. But these 3 are kind of at the discretion of the company. Okay, they can choose which one they want. And depending on that choice, you're going to get 3 different kind of effects on your, or like the outcome on your income statement and your balance sheet are going to be different depending on which one of these methods you choose. Even though you have the same number of units being sold and the same revenue, sales revenue, the way that you're going to calculate cost of goods sold is going to be different between these 3, and therefore your expenses will be different, and therefore your inventory will be different, and your profit will be different, because these are ways that we're calculating cost of goods sold. And we know that cost of goods sold and inventory are like, one is changing from one to another. So if you change cost of goods sold, you're going to change inventory, and because those 2 accounts are kind of linked together. Okay, one key point is that the costing method is not the same as the physical flow of the units. Okay, in most cases, the actual physical unit flow is going to be first in, first out, and we'll talk about what these are. But usually, you want to get rid of your oldest inventory first. Okay, and that's kind of what first in, first out is. Okay, so again, this is just a way to get to a cost of goods sold. Really, we need to figure out a way for our accounting books to calculate cost of goods sold. And that's what this method is really for. The physical flow of things is going to be, it's going to be different depending on what the business is kind of, especially if it's like food, right? Food, you don't want to just keep stuff sitting on the shelf. So you're going to kind of try to sell the oldest stuff first, right? And I would say it's hard to think of any inventory where you wouldn't want to do that, even for the clothes or whatever. Fashion, fashion goes out of fashion quick, so you probably want to sell, whatever inventory earlier. Okay, so again, the choice of this is directly gonna affect cost of goods sold, right? That's gonna show up in your income statement. And because if you remember, our journal entry is cost of goods sold debit, inventory credit, this is going to be a balance sheet account. So whatever we kind of choose to calculate this, it's also going to affect inventory. Okay, so specific identification, it's really for when you can, as the name implies, specifically identify each unit in your inventory. Okay, so how are automobiles, how are they identified? Uniquely. What is the unique identifier called? Yeah, the VIN number, right? Every car has its unique kind of ID called a VIN, right? Vehicle identification number. So you can, if you had 1,000 cars, you can track them individually, and you actually know, especially for Toyota or these automakers that are like very, very good about their inventory management. You even know the cost of that. You know the cost of that exact car. Okay, and so you can track them when that car sells. You can then see what that costs, what that car costs to make, and you can expense it exactly. Okay, uh, other things are easier, like jewelry. These are like individual pieces, so that's like very easy to track, and they're kind of like they're like unique, you can say. So you can use this method because again, you know exactly which item you're selling, and you know how much you paid for it. Okay, so it's easy to do the matching of the revenue and the cost of goods sold. Art, again, no 2 pieces of art are exactly the same, so you can track those individually. Customized product. Real estate, no 2 pieces of real estate are exactly the same. Even in a tract home, my parents live in a tract home kind of development, and I was just sitting in the backyard, and their backyard is like open to like this government land kind of. And so even though there's a house like kind of across the street that looks like theirs, it's not the same because that land is different. And they have a better backyard, and this is like, so every piece of real estate is uniquely identified. It's got a unique address, right? So it's easy to track the sale of real estate too because each one is unique. Okay, so again, if you can identify specifically which item is being sold, you also can track how much you paid for that unique item. And so you can exactly match your revenues and your cost of goods sold. So this is, again, a kind of niche uh, costing method, but again, you have to be able to track each individual inventory item individually, right? It's not like Amazon where they have, 50 toilets, right? Because each of those toilets is not, you can't identify each toilet specifically. You only know that it's like the same toilet, but the toilets are a kind of a commodity, so you can't really track them individually. So this has to be each individual item in your inventory has to be trackable. Because again, the toilets, it's kind of the same as this example that I was doing above here. These could have been bought 10 units of toilet, right, for some amount. So because I can't individually track these 10 toilets versus these, because they're all the same model of toilet, I can't really use specific identification because they're all different costs. Okay, so the key takeaway is that each individual item has to be trackable in order to use specific identification. I'm just going to talk about what these are. I'll do one example, and then we'll probably spend the rest of the class just working together on doing this. Okay, so LIFO versus FIFO. LIFO is last in, first out. You can think about it as a stack. Okay, and how do you kind of cost the inventory? It's you just take whatever is on the top, right? And whatever comes in is going to go on top, and whatever is being sold is going to come off the top, right? So this is like you can think about it like a stack of boxes. You can think about it like if you're at the buffet, they stack, they have the dish thing, and you like the dishes on the bottom maybe never get used in 20 years, because the clean dishes they put on top, and then when people come, they take the dish right off the top. So there's a bunch of dishes at the bottom that maybe never get used up, right? Because it's just whatever comes on top gets used first. Okay, so you can visualize this however you want. It's also used in computer science, stacks versus heaps. I don't know if you guys, if that's like there's like this idea of like which one goes first there's a lot of real life kind of examples of this these methods showing up. Okay, so inventory costing, you can learn it. You might see these in different contexts in your business career. Okay, FIFO is kind of like a line of people. Okay, this person that's being about to be served has been waiting the longest, right? This person in the back just got there. Okay, so it's like the oldest one goes first. Okay, so this is stack versus queue. Okay, the stack is LIFO, a line, a queue is FIFO. Okay, so keep these straight. However you're going to do it, each person is different, how you want to visualize it or think about it. But I think these are kind of helpful, a couple ways to think about it. You can also think about FIFO as like the milk at the grocery store. They put the oldest one in the back, and the one that's closest to you is like the oldest, or sorry, the newest one in the back. The one that's closest to you that you're pulling out is the oldest, right? Because they're trying to get rid of that first. Okay. So again, however you want to think about it. If we use LIFO as our costing method, the cost of goods sold is going to reflect the most recent price of our inventory, because as soon as we get inventory in, we're going to use that price as the cost of goods sold, because again, it's LIFO, right? So if we paid, let's say we paid $1 for these, $2 for these, 3, and then 4. We bought this most recently, but this is also going to come out as cost of goods sold. So this old one is just going to sit here lingering at $1. But that's good. I mean, you can argue it's good because cost of goods sold is going to be accurate as to what the current market is for that particular item I'm selling. Okay. The problem is though that inventory layers, these LIFO layers as they're called, your balance sheet is going to be wrong. Okay, because it's going to have these units that are at the bottom listed being worth $1, but they're actually worth something else because the more recent price has changed. So it's gonna create this distortion on your balance sheet. Okay, so that's the trade-off with LIFO, that you get more accurate cost of goods sold as per like the latest market for that item, but your balance sheet is gonna be kind of messed up because it's gonna have this old inventory with stale cost hanging out on the balance sheet. Okay, FIFO, it's kind of the opposite. Your inventory is based on the oldest inventory, but it's kind of refreshing all the time. So you don't get this like stagnation at the bottom. Okay, because it's rare that a business will sell out all of its inventory, right? That's the only way under LIFO that this $1 inventory will get costed if they sold everything, and that's rare, right? FIFO keeps things a little fresher because this person in the back is eventually going to get to the front. Okay, while in LIFO, this bottom one can just stay at the bottom forever. Okay, so this is just a math question. Okay, we're going to talk about this last method. If you have 10 units at $5 each and 50 units at $70 each, is the average price of $6 for the 60 units? Does that make sense to use? Think about that. Think about it for a minute. Talk to your neighbor. Discuss if you think that that's fair. Because remember, how did I get $6? $5, $7. The average of 5 and 7 is $6. Okay, Scott was very enthusiastic. So Scott, what do you think? Okay, you're doing the math in your head. Okay, so let's just unpack what Scott said. Okay, he's saying that you had 50 units at $7. So that value of that inventory is 350. And then you had 10 units at $5. And the value of this is $50. Agree? Do we agree with that? Okay, so if we add this up, it's $400. And how many units is this? Is it gonna, how about this? Before we do the math, is it closer to 5 or is it closer to 7? Closer to 7, right? Because there's more $7 units. Okay, so what we just did here is basically calculate the weighted average. The average cost is just that, that the average price paid is $6. But we also have to factor in how many units of each of those there are to get the weighted average. Okay, so the way you do it is basically figure out the total value of the inventory divided by the total number of units. It's not more complicated than that. Okay, so what is this? Does anyone want to help me with the math? 6.67. Okay, and as we estimated, it's closer to 7 because there's more $7 units. Okay, so this is the amount we'll use in weighted average to calculate our cost of goods sold. Okay, and we're only going to update this when we buy new inventory at a new cost. Okay, because that will change the weighted average. But until then, these 60 units, we can represent the value of them with one price. Okay, so this is actually, you can argue, the simplest method. You don't have to keep track of all the different layers, and you can just kind of average everything together. So yeah, I think we kind of did it, but just to make sure everyone understands, the weighted average, the formula is the total value of the inventory divided by the total number of units. And again, this is going to cause the weighting to be towards the cost that has the most units. Okay, because that's going to kind of like skew the total value of the inventory. It's going to be weighed more heavily for whichever price has more units. Okay, so in this example, beginning inventory is 5,000. We bought 10 more units for 2,000. So how much was this per unit? This is easy math. This is $200 per unit. Okay, and if we started with 10 units, how much was this per unit? The beginning inventory, it's $500 per unit, right? In this case, we're actually going to get the average because we have the same weighing. The beginning number of units and the number we bought is the same. So it is actually just going to be the average of 500 and 200, which is 350. But again, if we had 100 units, it's gonna weigh depending on the number of units. So hopefully you see that, and you're gonna get practice with this. So, but in general, I think the easiest way to do the calculation, you just figure out the total value of the inventory. So in this case, it was 7,000 divided by the total number of units. Okay, and that will give you the weighted average. Okay, um, and it's gonna actually result in a middle ground between LIFO and FIFO. So LIFO and FIFO, we're gonna see kind of one will give you like the highest cost of goods sold, and I don't want to say highest because it depends on like let's assume what is the normal kind of direction that prices go up, right? What do we call that? Inflation, right? So if you assume that the price of whatever your inventory item is going up, which one is going to give you the higher? Let's start with profit. Which one gives you the higher profit? LIFO or FIFO? Exactly. Okay, so look, if we're assuming that prices are going up over time, LIFO is going to have a higher cost of goods sold because it's going to use those newer, higher dollar price items in inventory as your cost of goods sold. And if you have higher cost of goods sold, that's going to cause your profit to be lower because cost of goods sold is an expense. So a larger expense is going to result in a lower profit. Okay, and so the opposite will be true with FIFO. FIFO is going to give you the highest profit because it's using the oldest value of the inventory, and weighted average is going to be in between those two because it's not using the oldest or the highest, it's using a blend of the two. And it's the opposite with inventory. Okay, so if LIFO is going to give you the highest cost of goods sold, it's going to end up with the lowest inventory value. Okay, your balance sheet will show a lower amount of inventory than it is going to be under LIFO. Okay, so again, if your cost of goods is higher, that means inventory is going to be lower. If your cost of goods is lower, inventory is going to be higher because those two are again trading off between each other. There are some businesses that will use FIFO for their financial reporting and LIFO for their tax reporting. What do you think the advantage is there? When you're calculating income tax, do you want to show more or less profit if you can? Yeah. So, or if you're a GM and you have to negotiate with your labor union, who is very attentive on how much profit you're making, maybe you want to understate it using a inventory costing method that is going to just lower it artificially. Or, if you're fighting antitrust regulation, oh, I'm not that profitable, or I'm not as profitable as I could. So there's reasons why a business may want to show lower profit than they actually are making. Amazon has been doing this notoriously for a long time. You can see they haven't made a net profit for like a long time because they basically expense their growth and their R&D and stuff. So it kind of has given them long-term revenue growth, but their net income has not been that spectacular. So yeah, this is why like knowing these accounting rules is important too. Um, Yeah, and they don't. Yeah, I mean, they get around the taxes using other things. They incorporate in Ireland and they do all these fancy like tax uh, transfers, basically. Um, Apple, I think, has Apple, Google, all these like tech companies. They're like notorious tax evaders, and it's not illegal. They're using legal loopholes to do this.